Hello, everyone. Thank you so much for joining us for the quarterly investment commentary webinar. I'm Margaret Sargent. I am a senior marketing associate here, and I'm very pleased to be joined today by our president and CEO, Dr. Richard Michaud, our CIO, Robert Michaud, and research analyst, Tali Rabanine. So Robert will be kicking things off today with a refresher on New Frontier's investment process and philosophy. And then we'll be passing things over to Vitali for a review of this quarter's performance, both as it relates to our portfolios and the market in general. And we will then open up the floor for Dick to have a discussion of his quarterly commentary and some highlights from that. We'll have some time at the end for questions, followed by a couple of exciting updates from marketing, so please do stick around for that at the end. A couple of just quick housekeeping notes. Your lines will be muted for the duration of the call to reduce background noise. So if you do have any questions as they come up, please submit those using the chat function of GoToWebinar, and we'll have time to address those at the end. So without further ado, I will pass things over to Robert.
All right, thanks, Margaret. So I'd like to start today, as always, with a review of the investment process, and I like to focus on this because we believe in portfolio construction for many different investment objectives that go far beyond just the news and what's happened in the most recent quarter, but that we'll be discussing for the rest of this webinar today. To help picture this process, it applies across a full spectrum of risk-targeted portfolios from 20% equities, 80% bonds risk targets, all the way to a full equity portfolio. And it also applies to standard tax-sensitive and our multi-asset income portfolios. So what is our investment philosophy anyway? We start with the principles of the most sophisticated and respected institutional asset managers, and we improve upon them by making sure we're not making mistakes. So among these things are temptations like trying to predict the future. We've all seen how worse forecasts do. Markets, we do not believe, are perfectly efficient, but we do believe that there is a fair amount of market information in them, and it is not a trivial exercise to be able to say where they're moving. That also applies to stock picking, picking active managers, going with a favorite asset class. All of these things have risks associated with them, and we do not want to take any risk that comes without compensation for investors. So what are we left with? Well, diversification in all of its forms. So across securities, our ETFs that we hold, 27 different ETFs, hold individually thousands of stocks and bonds, covering every major asset class. It covers different risk factors. We want to be fully geographically diversified. We don't want to be too much risk for any one country. And we also want to be diversified across time. And so this is where a consistent investment process can help you over time by not betting heavily on one particular market environment at one particular point in time. Other things we can do to help are managing costs, so limiting turnover, managing taxes, of course, lower cost ETFs. These all help. Of course, when you want to manage costs, you don't want to go all the way to zero. You want to manage costs, consider costs only to the extent that you're getting more benefit from the instruments you're owning than they are costing investors. And so there might be specific asset classes that may be some more expensive than others, like emerging market bonds, for instance. They give you some unique diversification characteristics that are worth paying more than 0 basis points for. Then we also want to be strategic but not static. And so this comes in to understand a changing market environment and try to get the best understanding of what the market is saying about the risk and return opportunities today without speculating about the future. And we need these understanding of risk and return today so that we can optimize portfolios and build portfolios that are both more suitable for investor objectives, and of course, seek to maximize return and minimize risk, but do the best job of balancing all the risk and return trade-offs across all the investment opportunities for different types of investors. And this is why when we're always thinking about the entire portfolio and how the portfolio behaves rather than one specific asset class at a time. This is an important thing to consider when you're thinking about what's inside our portfolio. Why do we still own some treasuries when everyone knows interest rates are going up? Why do we still have some emerging markets when we're in the middle of a trade war? In hindsight, it would have been great to just buy the S&P 500, but that's not the right portfolio going forward. So our process. One way of thinking about this is we have to go through all these steps, but another thing to keep in mind is that we do these things in sort of increasing frequency across here. So we evaluate ETFs, but we continuously, basically, but we replace and swap them relatively infrequently. We come up with new capital market assumptions as market information evolves, which has some higher frequency things like interest rates, but it also has, it's not the sort of thing that you want to radically change your capital markets every day. We optimize our portfolios, again, once a month or even more often than that. Our investment committee meets every week. But every single day, these portfolios are monitored to make sure that they have the correct risk characteristics, to make sure that they're statistically equivalent to the portfolios that we think have the right risk characteristics and are optimal for the different investor objectives. So we have one process, 3 strategies, 15 different portfolios for different investment objectives, and they all use our same capital market assumptions. They're all ETF based, but they are optimized for different investment objectives. So whether that investment objective is total return for an aggressive or a conservative investor, or it cares about the after-tax return for those types of investors, or whether income is sustainable and growing for somebody perhaps in a distribution phase, this investment process is consistent, but is optimized for these different objectives. And this allows us to allocate a portfolio among the many asset classes. And we want to remind you that we are an independent manager. So the only reason why any ETF is in any of our portfolios is because we think it is the portfolio that has the best characteristics for meeting our investors' objectives. This allows us to have ETFs from many providers that cover value, growth, international, domestic, individual, international markets, all the different risk premia and risk factors in both equities and fixed income world, as well as things like gold, low volatility equities, which may be more appropriate for more conservative investors, and more. So I can't go through all of them, but there's always a good reason why every ETF is in our portfolio. When it comes to building capital market assumptions, what we are trying to do is, as I mentioned, have the best understanding of the risk and return opportunities in the market today. And so that means using a combination of past data to understand risk, not so much past data to speculate about the future or extrapolate into the future. We do want to use academic theories and current information about such as yield curves, credit spreads, and other things to bolster this process and make the portfolios more relevant and more reflective of what's going on right now. The thing we like to focus on the most in many ways is optimization. And I like to start by talking about contrasting it to what you do without optimization. And many other managers, surprisingly to me, do the following, which is come up with a set of bonds that they think make sense. Maybe a different individual will come up with a set of stocks that make sense. And for all intermediate risk targets, they just connect the dots. Clearly, you can do better than that. Clearly, the most aggressive investors don't want the same stocks and the same portfolio bonds in their portfolio as the most conservative investors. Particularly in an environment like this, the most conservative investors might not just blindly want to own a lot of bonds. What they need is a portfolio that's really optimized for their specific objective. And the other thing that you get here is you're maximizing return and minimizing risk, and building portfolios that could actually perform better. So as a quick proof of concept, what do these portfolios actually look like? And you can see here that a conservative and an aggressive portfolio, if you just look at the bonds, we're always thinking about the whole portfolio, but for a moment, let's just look at the bonds. You can see that these are very different bond portfolios. And also, if you stare very carefully, you might find out today that the composition of these things have changed, and an aggressive portfolio today may have more credit risk and less duration risk than a conservative portfolio. So how do we do it? We optimize over thousands of different investment scenarios. We don't want to bet on just one version of the future. And what we come up with is a much better diversified portfolio that Nobel Prize winners like Harry Markowitz have said actually perform better out of sample. This is what they look like before and after, much better diversified portfolios. This is a statistical analysis of some of the outcomes where you can't control the future, but you can do everything you can to reduce risk going forward, reduce the future dispersion of your portfolios. And so if you're relying upon us as a core portfolio holding, then it's very important that whoever you use for your core portfolio doesn't take needless bets, doesn't time markets, and doesn't take any extra risks, because that's going to add to the dispersion of future outcomes. And while if you're right, it's great, if you're wrong, you're having a very unpleasant conversation with your clients, and that's what we're helping you avoid. And then the last piece is rebalancing. And so this is how our process works. You optimize, you have a portfolio, it's right on the efficient frontier, but over time, prices change and your portfolios drift. Also, what's going on is that new information is arriving to the markets, and so our entire concept of optimality is also changing. And so what we want to do is we want to not trade the portfolio every single day, but we want to trade the portfolio when it will benefit the investor. And so we want the whole portfolio test that's not just based on calendars or looking at one asset at a time, that understands when this portfolio is optimal and needs to be rebalanced and when it doesn't. So when and only when it's beneficial to the investor is when we rebalance the portfolio. So I want to hand things off to Vitaly now, and hopefully, as you'll see, that as we said, we are not just a static investment portfolio, that markets are giving new information, rates are rising, the yield curve is flattening, central banks are moving, and we're in a trade war, perhaps, hopefully not too bad, with China, and this is changing the investment landscape. And fortunately, we have actually done this in our most recent rebalance. We have taken into account the flatter yield curve, the increased risk of interest rate exposure, and we have made changes to these portfolios. And so hopefully this will help the portfolios going forward. And here you go, Vitaly.
Mm-hmm. Thank you for your overview of our investment philosophy and process, Robert. Now I'm going to take it away from here with overview of New Frontier performance, global asset class, and global asset class performance. So let's first take a look at what has transpired over the last quarter in global markets. A couple of quick highlights. U.S. economy is still functioning very well, and it's especially evident if you consider value growth splits that have persisted for quite some time now. Small cap performed well on a year-to-date basis, and demand for capital appreciation opportunity indicates a certain level of investor confidence. In this quarter, Japan did quite well too. As a matter of fact, most of the yearly gains associated with Japan came from the third quarter. Part of the reason for this is a decision by Trump administration to delay putting on tariffs on Japan until the trade talks. So effectively, first they decided to at least hold some preliminary meetings and then decide on the trade policy going forward regarding Japan. And as expected, geopolitical tensions, especially tariffs on China, have taken their toll. Chinese equities underperformed significantly, both mainland and offshore, posting negative returns for both quarter and the year. Another quick but important note on emerging markets is that rising interest rates have definitely contributed to their performance, because debt servicing costs have increased due to an increase in the cost of borrowing. Now let's take a look at how this has been reflected in New Frontier performance. Well, first we have standard portfolios, and what we see here is a slight underperformance compared to the benchmark across all profiles on quarter-to-date, year-to-date basis. The story is it's mostly the same story for the tax-sensitive portfolios, but more aggressive 90-10 and 100-0 profiles are slightly outperformed benchmark on a year-to-date basis. And multi-asset income portfolio results are overall mixed. On a quarter-to-date basis, we see the same slight underperformance relative to a benchmark, but outperformance across all profiles on a year-to-date basis. To put it all together, it hasn't been the best quarter, but yearly results have been mixed, depending on what kind of investor you are, what strategy you choose to invest in, and what profile you're investing in. Here is a quick little discussion of two topics that have been relevant across the news for quite some time, mainly dollar strength and treasury yields. There is a common sentiment that strength of a dollar and treasury yield are both driven by investors' level of confidence in an economy. Well, if that would be true, then that would imply a certain pattern between the two indicators. And here on a graph, you see in white a percent change in 10-year U.S. government treasury over the last 5 years. And in the orange, you see percent change in strength of a dollar against a diversified basket of currencies. And as you can see, there is no discernible pattern. At some point, it seems as if two indicators move together, but considering other time frames, they do not. So, for example, closer to the end of 2016, both of them moved together, but at the very beginning, you can clearly see that treasuries declined while dollar has been mostly static. And one of the reasons for this behavior is that yields are greatly influenced by the Fed. So treasury rates are anchored to a certain benchmark, but dollar is much less so. Dollar is globally priced, and U.S. is not a currency manipulator. So there is a greater range for foreign investors to affect that, while treasuries are more tightly controlled internally. Now let's take a look at the asset allocations that have transpired for us over the last quarter. We have traded standard portfolios, multi-asset portfolios, and mutual fund portfolios in August. And the common theme for that were geopolitical tensions that pretty much resulted in a slight shift toward domestic large cap equities, reduced duration exposure that has more to do with fixed income, obviously, and rising interest rates, as well as reduced allocation to China. And in general, as Robert has said, portfolios are being monitored on a daily basis. As soon as new information comes in, we evaluate statistical significance of a drifted portfolio versus what we believe is the best optimal portfolio at any given time, and we only trade when it is of a benefit to investor. With that, I'm going to pass it over to Dick, who is going to share his thoughts on what has happened over the last quarter.
Thank you very much, Vitaly. Thank you for the performance review. So it's my responsibility to talk a little bit about a quarterly market perspective. And some of you, I think, might be on the mailing list where we send out the commentary at the end of the quarter. So this was published exactly October 1st. It's kind of interesting. I think it's going to be interesting in terms of getting a perspective of what it all looked like at the end of the quarter versus of what all we can see and what's been going on since, okay? But the title of the commentary this quarter was a historical market, bull market, okay? Just a quick overview. The quarter reflected robust domestic economic growth and historical levels of market indices. Sharp contrast with many of the world's economies and financial markets. That's what happened. The Fed raised interest rates, and the administration announced a number of new tariff policies. And the new Trump tariffs roiled many global economies and financial markets. It's been a historical milestone. We've seen the longest bull market in financial history. Pretty amazing. Okay. More than 9.5 years of rising U.S. stock prices, extreme low volatility. This is what's been very strange for quite a long time, since March 2009, with some exceptions. So the gains have been similar to much shorter time period relative to the good old 1920s. In contrast, hedge funds and value funds, in many cases, have underperformed the S&P 500 for the last 10 years, even as they accumulated record levels of assets. So many different things going on in the market at the same time. So the Fed raised the fund rate. The Fed announced interest rate hikes at the end of September. The Fed fund rate rose 0.25%, and I'm pretty sure what everybody knows. They also were very, very optimistic about the American economy. They've seen as a particularly bright a moment for the economy. The rate rise was not expected to get in the way of the continual growth, according to the committee. The committee expects continued 0.25% rate hikes once this year, in December, twice next year, and almost certainly in 2020, unless things change a lot. So people have been worried about an inverted yield curve and the possibility of a recession. Well, according to the committee anyway, in the foreseeable future, it seems very, very unlikely, according to the Fed. International markets, as Fidali was saying, has been a serious challenge for anybody who is a U.S. dollar global investor. The U.S. has been robust economic growth and rising rates, but trade risks and unsettled global economies have resulted as a consequence. It has negatively impacted a number of international economies already experiencing a slowdown in economic growth. There have been very few places to hide. Japan was a happy exception during the quarter, and not recently, of course, as you may know. Many world markets did underperform. China was one among the most serious of the underperformance, and we'll talk about that in just a minute. Dollar-denominated emerging markets impacted by strengthening dollar and currency fluctuations were negatively impacted in Turkey and Argentina, and a class of their own. Okay. So one of the more important things that happened in the third quarter had to do with the Trump tariff policies. As you know, the president has an America First campaign promise, and in that context, he considers many, if not almost all, of the trade agreements currently have been unfair to the U.S., and he's in the process of renegotiating pretty much all of the world trade agreements. And just recently ended some with Mexico and Canada, but there are more to come. In the president's view, in particular, China is the unique offender. China's relentless policy of intellectual property appropriation has been part of the Chinese goal for economic military dominance by 2025. That's a state policy. And the Chinese policy has already resulted in many lost American jobs. So President Trump imposed 10% tariffs on pretty much all of the goods coming in from China, $200 billion in Chinese goods, in addition to the tariffs that had already been imposed earlier. And that 10% is expected to rise to 25%. This is a very serious issue here. An all-out trade war seems possible here with the second largest economy. That if it begins and it continues, it could last not just a few months, it could last actually years. Something for investors to really think hard about. Now let's go to the European economy, of course. Europe is America's most important trading partner. So the European Central Bank has implemented 2.5 trillion euro stimulus program over this time period. But happily enough, the Eurozone economy has revived since the contraction a decade ago. The ECB is ending the stimulus program by the end of the year. Interest rates are to remain steady through the middle of 2019, as far as anybody can foresee. And a termination of the stimulus program has been due to some fairly serious positive economic factors in the Eurozone. But especially near the end of September there were recent worrying signs of a slowing economy and very flat markets. Trump plans to impose tariffs on many European goods, and by all indications, I think the status is that Europe is in guarded economic health. That is my view. Okay. But let's look ahead just a little, okay, as best we can, of course. The trade wars and central bank policies are likely to dominate the near-term economic and financial markets. America continues the role of being the economic growth engine for the world economy. The major political and economic risks exist with some very serious unforecastable consequences. So, talk a little bit about this natural rate or the neutral rate, okay? So the Fed subscribes to the monetary concept of the neutral or natural rate. The neutral rate is where the economy is in equilibrium. Fed policy, neither loose nor tight, economy neither hot nor cold, a perfect kind of running economy. So if the rate is above the neutral rate, that stimulates the economy but increases inflation. If it's below the neutral rate, the increases unemployment and lowers inflation. So the Fed believes that the neutral rate or the natural rate is at 3% for the American economy currently. They also consider the terminal rate of all of their rate increases to be 3.4%. Of course, this could be something in the future. Yeah. So what is really important to investors in terms of what the moral of this story is, the Fed is on course for nearly automatic rate increases to 3%. Now that's really important for anybody who's thinking about all the consequences of the issues going on in global economy. Now the true natural rate is never known. It's a theoretical concept, and we can only guess, and the Fed is only guessing, and only time will tell if the natural rate, if it exists, by the way, is at 3% or more. And I think one of the most remarkable things that's been happening during this period of time here is the unprecedented, and in spite of the unprecedented U.S. political turmoil and dysfunction, the stock market has remained amazingly calm, preternaturally calm, I would say. I remember seeing the market day after day, and there's hardly anything changed, except for maybe a small tick up. The S&P has gone many trading days without a 1% move. The summer was another quiet trading period, continuing into September. The VIX was virtually non-existent in terms of its minimal value. Corporate earnings were growing at a fast pace. Everybody was very euphoric. The market has been convinced of a robust American healthy economy. And the gradual rising rate environment, which is being pretty much on automatic, is no threat to economic growth. But as I just talked about in the commentary, many analysts have remained very cautious. I think we are as well. And many analysts are waiting for perhaps new catalysts, such as trade discussions or political events before making any major changes. That's what we said at the commentary. Now, tariffs are a two-edged sword, okay? And it's quite a big sword in many, many ways. Currently, the Trump administration is willing to wage trade wars with pretty much anybody in the world. It's pretty much concerned about being unfair by many, many economies and countries. Now, unfortunately, a trade war is a disruption of long-standing trade patterns, and how these disruption of these trade patterns, what are the implications? It's really impossible to answer. Another thing, of course, as I'm sure you know, is that tariffs is a tax on the American consumer. A tariff requires stipulation of which goods and companies to exempt. And various exemptions can easily lead to political corruption. So it's really a concern from many different angles. Trust is an essential component of any successful negotiation. Every person on this phone call and this webinar, I'm sure believes that. You need to trust facilitates growth. It requires a respectful negotiation. there's been a lot of concern that America may be seen as an unreliable partner that may impact trade deals for many years to come. Trade wars really are only a last resort. But with China, it's pretty much different. And I think President Trump has got a lot of economic consensus behind some of the issues that he has proposed. The long trade war with China is not at all out of the question. The prospect has severe global economic and military implications. China has been the go-to source for cheap, high-quality manufacturing, and it is, without any doubt, an intellectual powerhouse, although, as one might note, with often appropriated expertise. So how China would react to the thwarting of its global dominance ambitions? The U.S. tariff policies is an essential threat to the Chinese political class and to President Xi. It's a very serious issue here. The Chinese economy is awash in debt, and yet its presumptive adversary, the United States, has robust economic health. No way China can directly win a trade war with the United States if they decide to go head-to-head. China has many recourses, of course, for American firms doing work in China, but nevertheless, it's more of a skirmish than the major battle. The China-U.S. relationship, in my view, is one of the most dangerous global economic risks. As you know, trade wars sometimes lead to military conflicts, and that is not out of the question here. The Mueller investigation continues on its path with truly unforecastable political risk. It is clearly not a witch hunt. 100 criminal counts have been filed against 32 people and 3 companies. There are 8 guilty pleas and convictions with people in jail as we speak. There are 13 Russian nationals and a Manafort associate that has been indicted for conspiracy and obstruction of justice. So the probe is driving political calculation in Washington, D.C., with possible explosive political risks at any time as the midterms approach. At the European Central Bank, there is a changing of the guard. Dr. Mario Draghi's term as president of the ECB ends in October. Dr. Draghi is an MIT-trained macroeconomist, and his term has been widely considered a major success for reviving the economy. However, likely replacements may or may not follow a similar path to what Dr. Draghi has pioneered. The outcome of the political debate associated with going on in the Eurozone may have some serious consequences going forward, something to be paying attention to. You don't get something for nothing in finance. A growing federal debt now exists. The Fed stimulus program and tax cuts has come with rising debt. Currently, American federal debt is 105% of GDP. That level has only been exceeded during the height of World War II. Now, debt is a positive for running an economy to avert a depression, to fund a war, and to build productive infrastructure. But the recent tax reform legislation was more political than economics. The federal debt interest is the fastest growing major government expense. Within a decade, interest on debt may be more than military, Medicaid, and children's programs combined. I think I want to emphasize that point once more. Within a decade, interest on debt may be more than military, Medicaid, and children's programs combined. Indebtedness will have to be paid by future generations or a shutdown of entitlement programs such as health care and Social Security benefits. This last slide is probably as important as any of I've had here. The complacency era. Low volatility and a long bull market has inspired policy complacency both economically and politically. Up until now, the market has been independent of any convulsive political turmoil and any congressional dysfunction. But things always take so much longer than you think in finance, and then they happen so much more quickly than you can possibly imagine. The economy is not immune to incompetence and political stress. The continuation of a robust business climate depends on sound fiscal and monetary policy and good political function. At some point, the bill for extreme partisanship and ignoring infrastructure needs and productive tax and entitlement reforms will come due. I'll turn it over now to Margaret Sargent, who will continue the presentation.
Great, thanks, Dick. So we do have some time for questions. As a reminder, your lines are muted, so if you do have questions, please submit those using the chat feature of GoToWebinar. And while you take some time to formulate those and send them in, I will run through a couple of updates from marketing. So just a quick reminder of the team that's here to support you at New Frontier. I think for many of you, these are already familiar faces. David Schubach is our man out in the field. I think he has already met face-to-face with many of you, whether that is at conferences or at one-on-one meetings. And then Nick Lamb and myself are here to support you in the office. So any questions that you might have or material requests, we are more than happy to help you with that. So if you have any questions that aren't answered on today's call, please feel free to reach out to any of us. We are more than happy to help you. And as always, I encourage you to take advantage of our advisor portal, Frontier Advisor, which is really designed to be a one-stop resource center for advisors. It has portfolio analytics and marketing materials, as well as of very recently, our brand new proposal engine, which we built to give advisors the ability to run custom proposals for their clients right on Frontier Advisor. So this system is great. It was built with the help of our brilliant in-house tech team. It features a simple user-friendly interface with customizable inputs and creates a proposal for your clients that featured detailed proposal descriptions and analytics, as well as comprehensive educational materials that you can leave with your client focused on New Frontier process and philosophy. So that's going to be found under the Tools tab of Frontier Advisor. And we do have a webinar coming up that'll demo this system on October 16th, that's next week. And we encourage you to join us if you'd like to see a demonstration of how the proposal system works. If you can't make it, or if you would like a personal demo run for you, or just help running your own proposals, please don't hesitate to reach out to Nick. He is more than happy to help you with that. His contact information is at the bottom of the slide and also will be featured in the follow-up email that we send out. So it looks like we don't have any questions coming in. Like I said, if anything came up that wasn't answered on today's call, please feel free to reach out to Nick or myself, and we can talk to you about that. That is all that we have time for today. So thank you all so much for joining us, and we will see you next quarter.